Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders are discussed and are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates or any of their respective offices, personnel, representatives, agents, or independent contractors in such capacities, licensed financial advisors, registered investment advisors, registered broker dealers. Nothing contained in this webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionscreen.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach the risks and potential rewards of trading options, and we are not the service that tells you what to trade. We are not implying guaranteeing any profit. As always, do not trade with money you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and only valid on that specific date or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of the information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. All right. Well, it is another record for the Dow and the S&P. Everybody's doing fantastic. Fantastic, I say. Everything is great, apparently. I mean, holy shit. 26,700, 2937, 7,600 on the NASDAQ, 1724 on the Russell. Now, the Russell was much, much higher at one point, so really they're kind of lagging on the recovery side. Where's FinViz? So let me put FinViz up. FINVIZ. And then we go to FinViz, and we go to the futures, and we go to the indexes, and we go to the weeklies, monthly. No, oh, I'm wrong. I'm sorry. I thought the Russell was behind, but it's not. They're apparently all just cranking up. So if you look on the weekly charts, they're all pretty much. The Dow is the weakest actually, because it's only just now taking back the early highs in January. But look at the catching up it did, right? See the size of that candle compared to everybody else's? So the Dow zoomed along to catch up. And now it's up a mile, S&P's up, everything's breaking out. And you know, it's like that pot stock, what's that pot stock called? Tilray. You can't bet against these things when they're breaking out like this. As crazy as it seems, I mean, that's what's going on. Let's see. What a great post. All right, I amuse myself. Let's see. Here you go. Look at this freaking thing. That's what I mean. That's what the Dow's starting to look like. We're not far off. Hang on, let's open a new tab. All right, so here's Tilray, and here's, where are we? And here's the Dow in a shorter term. Look, see, it's not much different. Rationally, that should terrify you. You should be like, oh my God, this is ridiculous. Here it is. Oh, see that? There's that chart for Tilray, and here's the Dow. So you know, this is crazy. And we're not. You know, you got to think about the fact that underneath this movement, you know, just like you look at Tilray and say, oh my God, they're not worth $20 billion. Where the hell would $20 billion come into the company from? That's the same thing on the Dow. The Dow has a nominal value of 5 trillion, $6 trillion, something like that. You know, for 30 companies. Well, let's see, Apple, yeah, about $6 trillion. Probably more now. I mean, I've lost track. But even whatever it is, okay. So when the Dow goes up, if the Dow goes up 10%, that's $600 billion more dollars. Where is this money? It's not flowing into the markets. That's the weirdest thing. There's outflows. There's net outflows from the market of actual cash. So money is going in. The weird thing is money is moving out of the market, yet the things or the stocks themselves are going up in price. So there's less money chasing more expensive stocks, which makes it even thinner and less supported underneath. But it can go on. I mean, this is what happens in a bubble. Bubbles tend to accelerate towards the end, not decelerate. Who knows exactly how long this can go on, but it's really dangerous. It really is. Oh, and speaking of dangerous, I was just saying, I was looking over the portfolios. Look at the freaking long-term portfolio. I mean, it was like 60% or less than 60% like last time we did a webinar 2 weeks ago. It's up 20%. We didn't change anything. We added a couple of positions, but nothing significant. This is a bubble. You shouldn't make this kind of money. There's something wrong. Look, we hit $900,000. We started the year at $500,000. We made 80% for the year. This is ridiculous. And we're going to go through that. We reviewed everything but the long-term portfolio in chat. We're going to go through it, but it's crazy. This is irrational money. You shouldn't be able to double your portfolio in a year. I don't care how good of a freaking stock picker you are. It's crazy. Look at Money Torque. I bet Money Torque zoomed up also. 76%. That wasn't up 76%. Yes, I forget what it was, but it wasn't 76%. The OOP, 40%. I swear to God, we just did the review. It was nowhere near 40%. Not a thing was touched since I did the review. Somebody help me out here. When did we do a review of the options opportunity portfolio? I think we did it Tuesday. Okay, here's the OOP review, the options opportunity portfolio review from Tuesday. I didn't do these moves are not logged in. Any changes are not logged in, so it's exactly the way it was. We were at 37.3%, 137,000, and now where'd it go? And now we're at 40.8%, 140 plus. So we made $3,000 in 2 days doing nothing. Just boom, up 3% in a couple of days. These are insane returns. And the difference, by the way, the long-term portfolio is going up faster because it doesn't have hedges. The options, the hedges are in the short-term portfolio. The long-term portfolio is completely bullish. It's 100% bullish. There's nothing bearish in that portfolio other than short calls we sell against positions. So when the market does go up, the long-term portfolio is fantastic. But this is crazy. This is not normal. This is, and you have to recognize when you're in a bubble, you can't just, you can't just act like you're going to keep making this kind of money. It's freaking lucky. And as I was just saying in chat before, I'm like, we should really maybe take all this crap off the table. But I said that in May or June, and I was totally wrong. When the end of May into the summer, I was like, well, let's sell in May and go away, because I was really inclined to get out. Now, to some extent, though, the portfolios are very different. We did take profits off the table. We've taken most of our winning positions have been taken off the table at this point, and now we're sort of working the losers. And that's actually one of the reasons the long-term portfolio is doing so great, is because in the last review, we I didn't have a link to it. Do I have a link to that? That'd be nice. In the last review, here's Thursday. Ow. I use this keyboard's new on this computer. I'm not used to it. Oh no, I didn't do the link because I didn't finish the review yet. That's still in the draft. Anyway, so the last time we did the review of the long-term portfolio, though, it was we did a lot of bullish changes. Well, in CMG's case, we did a bearish change. Anyway, so I had been consciously trying to catch up because I was like, we're not bullish enough for the way this market is going. So back in July, we started adding a lot of bullish positions. But this is just crazy at this point. It really is. And again, it just makes me very nervous, and it just would be such a crime to burn a $400,000 gain. And then obviously we wouldn't lose all 400,000, but even we're dropping back $100,000 is hard to come by. I don't want to give back $100,000. I got 2 daughters in college. I don't want to give back anything at this point. This is not a year where I'm inclined to spend money. Wow. You can plan for college all you want, but when you have to start writing those checks, you want to shoot yourself. It's crazy. Anyway, any questions? Nope. I'll just continue ranting then. So this is Tilray, the pot stock. Now they're down 20% for the day. Look at it. They've gone from 300 back to 150 in 2 days. But of course, they went up to 300 in 1 day. It's just yesterday, 150 to 300 yesterday. Today they're back to 150. And it's very tempting to short something like that, but the question is when? What if it went to 450 today? You can't short something like that. It's not just that it was ridiculous at 300, it was ridiculous at 150. And it's still over 150 now. It was ridiculous at 75. There's no end to the ridiculousness of this stock. And I'm a fan of pot stocks. We just spent $1.25 million to become part of to invest in a pot company. So I love pot stocks, but this one's crazy. I will say we just invested in MJ. Did I put that in the portfolio yet? What was that, the short-term portfolio or the long-term? MJ. Okay, MJ is it's not supposed to be a pot ETF. It was a sort of like it was tobacco and cannabis and whatever, but it's now become more of a pot ETF. But the good thing is they invested in all these Canadian companies when they were very cheap, and now they're getting much more expensive, so they're doing very well. Tilray is messing with their holdings, but we just did a nice sensible spread on them. We just added this like yesterday. This is a short-term portfolio because we want to keep an eye on it. But again, why did I add a bullish pot play in the short-term portfolio? Because we're going to lose our asses on the short plays. We've got shorts on DXD. We have DXD as a short, is a hedge. It's a big hedge though. 27,000 minus 15, so it's like $9,000 in that hedge. Not $9,000. That's a short put. So just this hedge is $18,000. SCO is oil down. That's not really a hedge. This one's got $32,000 in our SQQ hedge. And this one's got nothing because apparently we were kind of even. Oh no, I'm sorry. Those are short puts. The short puts can burn us, and we can end up paying money. So it's really just the 13th. This one's about $12,000 in that spread hedge. So we got $100,000 worth of hedges here, plus we're risking being assigned on the short puts. So we have a lot of risk here. But the nice thing is because we take plays like MJ. Because we take we have Celgene over here. We had Apple, we cashed that out. We have our short puts up here. Because we have these long-term plays, we mitigate a lot of the damage that's done to us by the IQ's another long play. And again, another risky long play. We put risky long plays in the short-term portfolio. But why do we have long plays? The long plays are to hedge the hedges effectively, because when the market's running up like this, then hopefully all these silly long plays do well, and it offsets the cost of the short positions that we have here. The short positions are insurance we're supposed to lose, and frankly, even if this portfolio happens to be up 129%, but even if it was down $100,000, it wouldn't be a big deal because it's supposed to be down when the long-term portfolio is up. As it stands, though, we have now made, we've made 100% for the year in our two portfolios. We have just under $1.2 million in the two portfolios. But it's crazy. You're not, the money doesn't grow on trees. It's got to come from somewhere. You can't just, if everyone on earth was playing the market and you said to everyone, well, okay, you all doubled your money this year, there'd be a problem. And so what's a problem if everyone does it is still a problem if a few people do it. But the thing is that when a few people do it, they get away with it. You know what I mean? Like if you have a dish of Halloween candy and it says take one, and you have 100 pieces of candy and you know there's like 80 kids in your neighborhood, it's not a problem if a few kids take 2 or a couple of kids take 3. But if everybody takes 2, you don't have enough candy, right? It runs out. And so it rewards the quick and the greedy. And that's what we are. I'm sorry to say, but I mean, look, we are generally the top 1%. I mean, most people, if you have time to sit on your butt here investing during the day instead of like working at a real job, you're probably at least in the top 10% in the country. You have it better than most people. And I was pointing out the Social Security thing. That was an important point I made today, which I'd like to actually go over. This morning's post. There you go. Randy's with me on the 2 college kids at the same time. You poor bastard. All right. So in the morning post today, I was talking about, where are we? Well, I was talking about 2 things. First of all, this is very important. What happened to this? What was this picture? It was always an unflattering, look at it. The unflattering cartoon about Jamie Dimon has disappeared from the internet. See, isn't it great to be rich? Jamie Dimon sees this thing in PhilStockWorld and he goes, hey, get that picture out of here. See, when I put a picture up, I'm just linking to the original picture. So it wasn't like us. He didn't call us and say, take it down, because I would tell him drop dead. But he called whoever made the original picture and obviously had it, removed, which is lovely. Anyway, so Shanghai Stock Exchange down 20% for the year, and down 50% from the all-time high. So they're in a bad correction territory here. Jamie Dimon says, don't worry about the trade. And this is why people are pouring into the market, because Jamie Dimon, very influential guy, says, this trade's not a big deal. Who cares? A little trade, he says, is a skirmish. And then, of course, all the Trump people are telling you it's not a big deal. And not only is it, they're saying, A, it's not a big deal, and B, we're winning. So if it's not a big deal and we're winning, then it shouldn't really boost the market, right? Because if you win, but it's not a big deal, it doesn't matter. But somehow they manage to convince you when you're winning, and it's a big deal that we're winning, very bullish, while Dimon says it's not a big deal, but it's not a good idea. And I point out, here's a video of Jon Stewart from the last crisis. It's the same game plan. In 2008, things went up and up and up. Or 2007 and 2008, things kept going up and they kept being supported and they kept going up, and the bears eventually relented one by one by one. The bears will give up. All of a sudden, nobody was even hedging anymore, because it seemed like the market was never going to go down. And they told you how this time is different and it's a new paradigm, and you have to look at the global situation and blah, blah, blah. Well, CNBC is putting on MJ right now. That's funny. CNBC right now is featuring MJ as a thing to watch day after we pick it. Anyway, so they tell you how great everything is and how you shouldn't worry about this and don't worry about that. And even though you see this as a problem, don't worry. Like, and right now it's being the same thing. They're saying ignore China. Okay, it's only the second biggest economy in the world. Who cares if they're in a stock market correction? Can't hurt us. We're on the other side of the world. And that's not true. So it just takes time before you feel the repercussions. And then people think if something doesn't happen instantly, it's not going to happen at all. That's not true. So then, and what really got my concern today was that the Social Security Fund, they just did a new reports, and the Social Security and the Medicare have both been accelerated 3 years closer to when they're going to run out of money. And for Social Security, that's 2022. And it's almost 2019. And nobody cares. Now, they're not going to stop all of a sudden. What's going to happen is they have a principal, right? And the principal of Social Security that is getting interest, right? So they in theory, the interest should be enough to cover, but it's not. So the principal of $3 trillion in Social Security is getting not even 3% interest. But 3% interest on $3 trillion is 90 billion. It's $90 billion. It's $90 billion. So that's all the interest they get. It's $90 billion. So it's not enough. Now money comes in because people who work are still contributing, but the interest they're getting on $3 trillion is only $90 billion at 3%. In no way, shape, or form covers their outlays are like $900 billion a year. Inflows are just about $800 billion a year. So effectively, it's almost break even right now. But what's happening is more people get old, less people work, so on and so forth, and eventually it erodes to the point, and that's the crossover point in 2022. They're effectively underwater to never recover. And why are they never going to recover? And what happens? What's going on? Mostly it's this. Here we are now with 45, 50 million people roughly getting benefits. And here we are in 2022, 60 million people, 10% more people will be getting benefits and more people won't be working. So 10% more people get benefits. Then it's 20% more people, 30% more people, 40% more people, 50% more people. Wait, I'm doing the numbers wrong. If we're at 50, this is 10% more. Oh, I'm sorry, 55. This is 20% more. That's why I knew something was wrong. This is 20% more people getting benefits in 2022. So if it costs us $1 trillion today, it's going to cost $1.2 trillion in 2022. So if our reserve is if the reserve is $3 trillion, that means you're eating into your benefits. But then there's other things that make it worse. And then so here you're cutting into your benefits at a rate of $200 billion a year at least. Here you're cutting into your benefits at a rate of $400 billion, your base at $400 billion a year at least. Here you're cutting into your base at $600 billion a year. Now you only have $3 trillion reserve. That means that once you hit this pace, you're 5 years from zero, and that's why this is your bust date right here. That's it. And bust means zero. Zero money in the fund. Zero. Gone. Nothing. There's not a penny to pay 80 million people who are retired. And I imagine that is most of the people here by 2035. Right? 17 years from now. Or you wish it was you, but it's not. Okay? If you are, I'm 55. Am I 55 still? What am I? Yeah. I'm still 55. Okay, I'll be 55 until next year. I'm 55, and but already the brain is going apparently. So I'm 55. 17 years from now, I'm 72. You are delusional if you think that you can retire. And yeah, I can say, oh, well, I can retire at 65 and I can collect for 7 years. No, because they're going to cut the benefits. They're going to try to extend the program, blah, blah, blah. But even so, I can't live on that kind of money anyway. But even if I could live on that kind of money, it's going to stop. So if you stop working when you're 65, when you're physically capable of it, if you get to be 70, 72 years old and you're incapable of working, and then the benefits completely run out, you're just screwed. You're completely screwed. So I hate to tell you guys, but nobody can retire. You just simply, unless you have an incredible stack of cash and can live off it, you cannot retire. You can't afford to not work. That's the direction this country is. It's not, I don't want to say it's not that the country's heading that way. It's too late. We're there. You can't fix this. You could extend it by, like, let's say you take away the cap at $100,000 where rich people stop paying. People make more than $100,000 don't pay any more Social Security than the person making $100,000. So if you extend it so a billionaire pays his full Social Security, and so on and so forth, and corporations pay the full balance, the full matching, you would then extend the life of the program into the 40s or the 50s. But it's still, the pace at which we're chewing into the fund is unsustainable without somehow having a 20% tax on everybody. It's a plan. It could have been fixed here. But now it's too late, because we're now into the middle of the rapidly accelerating pace of people who are 65 and older. And God forbid they cure cancer, because this thing will go like this. If they cure cancer, this country goes bankrupt. That's the interesting repercussion of curing cancer. They cure heart disease. That's the other number one killer is heart disease, probably ahead of cancer. If they cure heart disease and cancer, either one, there would suddenly be millions of more old people, and the system, and not only that, but the old people who are here would live longer, and the system would collapse. So, if you ever see a headline, cure for cancer, get the hell out of this country. Because as soon as somebody runs the numbers, it's all over. So I'm disturbed by that, but again, you got to keep it in context, because nobody gives a shit. People investing don't care. Here's the trust fund. We're not here. We were here. When Al Gore wanted to put it in a lockbox, we were here. And he wanted to make sure that we never spent this money. That didn't happen. So where we are now is on the downswing already. The trust fund is now falling apart, and it'll be completely gone in 2035. And all we can do is lighten that slope, but there's no way to stop it. Not without drastic measures being taken that nobody's going to want to deal with. It is a complete mess. And you know what the problem is, unfortunately? Because the Democrats, every time the Democrats come to power, they're going to want to deal with it. And they're going to say, well, everybody's got to chip in 10% of their salary. There's no way around it. And the Republicans are going to come right back, and they'll get power back and say, we're not going to need 10% of the thing, blah, blah, blah. That's what happens every time. Al Gore, lockbox. They didn't elect him, right? He's supposed to put in a lockbox. George Bush is like, hey, no, we can give him out as tax refunds. Yeah, great. And that's what Trump just did too. He's like, no, I'm going to give you money. No saving money. I'm going to give you money. Everybody gets money. It's insane. We're basically a country that's on a suicide pact. And and again, when you make a lot of money, don't think you're going to always be able to make this kind of money. Things are going to turn sour at some point, and they're not going to recover very easily. This demographic is hell, and it's going to get worse and worse and worse and worse and worse and worse every year for the next 15 years. And the only thing that's going to turn that around is to kill instead of curing old people and having, curing cancer or whatever. They have to actually, you have to like start a soil and green project and start eating old people or something, because you can't do it. The other thing, you have to kill the old people. They're going to take all the money. And the sad thing is, and I did the math on this thing, that's the really sad thing. I did the math, and the way we took the money, you take it out of people's paychecks, right? So 6% comes out of your paycheck, and 6% comes out of your company's paycheck, out of their payroll, and it goes to the matching Social Security. So 12% of your salary for your whole life goes to Social Security, and they are supposed to, in the very least, put it into bonds. And I did simple math, and I said, let's say you only got 3.5%. Now, don't forget that in the 70s, you were getting 15% on bonds. But let's say you only got 3.5% ever. Even at 3.5%, even getting the average American salary, you would have put away, I'm going to cut to the chase, you would have put away $461,000 into Social Security over the course of your working lifetime. That's how much comes out of your salary if you earn the average wages for that amount of time. So if you contribute that's over 60 working years, right? That's how much you would have put away, 60 years. You would have ended up putting away that much money. Now, it's not inflation adjusted because it's based on what you actually put away each year. So in other words, back in the 50s and 60s, you only earned $6,000 as an average worker. And in the 70s, you only made whatever the hell it was. I wrote it somewhere. In the 70s and 80s, you made $40,000. I was like 50s and 60s, 20,000. Sorry, the average was 20,000. 70s and 80s, 40,000. And the 90s, sorry, 6,000 in the 50s and 60s, 20,000 70s and 80s. That's when we had the big inflation. And 40,000 in the 90s and the zeros. So in 60 years of working roughly, you made that much money, and you would have ended up putting away $461,000. So in your bank, Social Security, if you had your own little Social Security bank account, you'd have $461,000 in it, and at 3.5%, that would pay you $16,000 a year. $16,000 a year is what they pay you in Social Security. That's the average. That's what the average person gets, is $16,000 a year. So interestingly, this is why they call it an entitlement. See, look. Entitlement. It's called an entitlement because it's your freaking money, and you're entitled to get the interest on your freaking money. And even if they do pay you the interest on your money, they still steal it from you when you die, because Social Security doesn't pay your family the $461,000 you saved up when you die. They take it and liquidate it. And knowing that that's the math of the system should make you realize what an unbelievable ripoff this thing is, because they've been doing this for 70 years, and every time they steal your base amount. Nobody understands how this thing actually works. You give them the money. It's supposed to be held in trust for you. Right? They look at your contribution and tell you what you deserve to get back based on your contributions. Your contribution, if you're the average worker, was $461,000 over 60 years. So starting back, if you're retired now and you started working back in 1958, is when I was born actually. I was born in 63. But if you started working in 1958, and here we are 60 years later, in 2018, you put $461,000 into the system. And you freaking you are entitled to $16,000 a year. It's not a favor. It's not some socialist plot. You put that money away in good faith. The plot is that they're taking it away from you. The plot is that the government has taken that money, mismanaged it, and now they're blaming the victims, which is you, for the system falling apart. And here's the thing, who benefited from this? You know who benefited? They treated the Social Security income as if it was general tax revenues, and they spent it, and when they should have, in all this time, in all these years, when they should have been charging more taxes to the rich people, that's, even if it's me, it's still, we should have been paying more taxes because they shouldn't have pretended they had a balanced budget. And if they had done that, there would be plenty of money. But by not doing it for 60 years and pretending everything was okay, they have now created a crisis that you can't make it up, because realistically, now they have to take 60 years worth of money from me in one shot to balance the system. And I don't have it. I don't have 60 years worth of money to give them. If they would have taken it at the rate of 10% a year for 60 years, it would be fine. They wouldn't even need, they could have taken 1% a year for 60 years, it would have been fine. But they didn't. They kept pretending everything was great, and idiots like George Bush got up there and pretended that the whole thing was a surplus. And that we should then give back to people, right? You send all those refunds to everybody. It's horrifyingly mismanaged. It's a complete disaster. And here's the worst part. The worst part is that if you use a compound rate calculator, and I did, and you take the same money and run the same equation at the 8% normal stock market return, you would then have had, doing the same job, putting it away in the market instead of putting it in Social Security, you would have 5.5. So properly managed, matching the S&P over the last 60 years, you would have $5.5 million in your account. Now, look, to some extent, you can say, well, yeah, there's the argument for not having Social Security at all and letting people make their own savings and blah, blah, blah. That's fine, but what about the people you stole the money from? You took their money and you mismanaged it and you lost it, and now you're saying, well, it's a bad system. We shouldn't pay these people anymore. It's tough. It's a tough call because it's not my fault that they mismanaged it, but somebody's going to have to save these people. What are you going to do? Just say sorry to 80? How many? Wait. I just want everyone to understand the depth of this problem. 80 million, yeah, 80 million people. 80 million people are going to have nothing to retire. Nothing. They're going to be cut off without a cent when they retire. There'll be no background, no social safety net, nothing. Not a penny. And we're still not doing anything about it. In fact, we're still doing the exact wrong thing about it, which is giving tax breaks to the richest people in the country. And I don't know. I don't know what else to do. I can only talk about it sometimes. I don't want to be annoying about it. But on the other hand, sometimes you got to say it. I do once. So I try not to talk about it too much. But today those reports came out and I read them and I'm like, holy shit, how could it get worse? How stupid are we that it got worse in the last few years? I mean, of course it got worse because of Trump, but how can you let it get worse? This is going to be a catastrophe. And it really is, you think it's not a plot, but it's a plot. And it's a plot because here's what happens. The people who have money, yeah, sure, they take out some money from your Social Security. It goes in there, so what? But you know what else? You have more money than $100,000 a year, which is not taxed. You have more money to save. You put it into the market, and you were able to play the market, make your $5.5 million or whatever by investing. Poor people don't even have the option to do that because somebody took 10% of their money. So before they even get home, 10% of their money is gone. And they can't afford shit. So they can't take some of their other money and put it in the market. It's like, oh, nobody's stopping them from playing the market. Yeah, we did. We took 10% of their money, 12% of their money. We stopped them from playing the market. And you know what happens when we stop them from playing the market? There's less competition for us to buy stuff. So we get to buy stocks cheaper than if the poor people were playing along with us. So that's how it benefits the 1%. That's how it screws the poor people. It's sick. It's a really, really sick game that's been played on these people. And by these people, I mean basically the bottom 90% of this country. People who don't have $100,000 a year salaries. They all got completely screwed by this system. And now we're telling them, hey, I don't even know how you can say the word entitlement. I mean, I don't know how you can be so out of touch that you can say the word entitlement without any context of the definition of entitlement. They say these entitlements have to be cut. No, they're entitlements. That's the point. They can't be cut because they're entitled to it. But that's where we are. So anyway, in the short term, there's nothing to worry about. Who cares? Because nobody focuses, nobody thinks this far ahead. But in the long term, I'm telling you now, don't count on any money at all being there when you retire. That's number one. Don't count on any kind of medical care being there when you retire, because there's not going to be any Medicare either. Don't count on, and especially if we keep electing Republicans, it'll never ever happen. And in fact, I mean, that's what's going on right now. Trump is putting the nail in the coffin. He's making the problem so bad. And this is something that who's that horrible person? Grover Norquist, when Reagan was elected, coined the term starve the beast. And starving the beast means by not giving the government tax money, by forcing the government to run deficits, you put it so far in debt that it eventually collapses, and then they can't collect anything. If the government collapses, they can't collect any more taxes. And that's all they care about, is not paying any taxes. So the less taxes you pay the government, the less able the government is to chase after you for more taxes, and the less services they can provide, and the more busy the poor people are running around trying to make ends meet, that they can't worry about the politics of the whole thing, or they certainly can't think about what's going to happen in 2022 and 2024. So by causing the chaos, they create the situation in which they won't have to pay taxes. And that's where we are now. Trump is now putting the final nails in the coffin and making it so ridiculous. Because like I'm saying, I'm an incredibly liberal guy. I'm very happy to do what I can. I can't fix this. And I can't even come up with a way to fix it at this point. It's gotten so broken, it's pretty much unfixable. And so all you can do is what I do, which I tell my kids: you have to think about other countries to live in. You have to look at the rest of the world. You have to look in your career and your path and your life, and don't bog yourself down in the US. And it's not that other countries don't have any problems. Other countries have problems too, but this country has a disaster that is going to be completely unmatched in human history. And there really literally is not a solution other than basically just saying, okay, we're gonna give 40 million, we're gonna give 80 million old people a coin, and heads you die and tails you live, because we simply can't afford it. We cannot afford to support these people. And God forbid they end up living longer. There's not a chance in the world we can adapt to it. So keep that in mind when you're looking at all these wonderful medical things that save people and whatever. You can't afford it. There's too many of them. There's too many people living too long. The system was never designed for it in the first place. And that's getting worse, and now we've stopped contributing, so it's even worse than that. Anyway, all right, so sorry to be on a bad note, but it's crazy not to, if you don't keep this in the back of your mind when you're making long-term plans, and again, not now, but 10 years from now, 20 years from now, you're going to be in a world where you're going to say, I don't understand how this happened to me. How is it that I saved up my whole life to buy this little home in California, and all of a sudden the taxes are up 25%, and the system is unsupportable, and things are collapsing all around me, and I thought this was going to be my dream, and it's a nightmare. That's what I'm trying to avoid. I just want you to understand that's not that American dream is vanishing into the future, and it's the weirdest thing is how we're having this massive rally now as if everything is great, but it's not. We're just heading into more and more problems down the road. But again, they won't be immediate. We can rally like this for another year or two. That's the same thing with the .com. It's like everybody knew it was ridiculous, but it kept going. All right. So Eric says, trying to get back to like the market, have you looked at AES, Advanced Energy Systems? It's down Industries. It's AEIS. Okay. It's down nearly 50% since December. The reasonable P, focus on power conversion, control, options are reasonable, but not great. Okay, so I know I've not looked at AEIS. I don't know why they're down 50%. I think I might here. Here's my little, here's Stockopedia. I like Stockopedia, but you got to pay for it. AEIS, but they have my favorite. I like their financials the best. So what we see here is some don't know what happened there, but they seem to be fine. So pretty consistent revenue growth. Now, I always find it odd when you see these things suddenly spark up and they project it's going to get so much better, like all of a sudden, when there's no history of that. It went from 450 to 290 to 360 to 414, to 10% growth. Then you've got 20% growth here, but then suddenly you project. Well, you didn't project, it's actually what happened. You had this huge growth spurt here. I don't know why, but I need to know why that happened before I start assuming they're going to then jump up to 747 and 740 and 820. These are massive leaps in cash. Profit-wise, not bad. See here, they lost 158 million. It's weird. Made 127, 137, 147. The profits aren't growing as fast as the revenues. There's a lot of weird stuff going on here in these numbers. Net profit 187. One thing I look at though is in Yahoo Finance, because it's easy to see, AEIS. Sometimes you catch an oddity because this year there's a lot of this going on where people don't pay their taxes. So these guys did pay their taxes. Well, who were we looking at earlier? It was NXPI. So NXPI's profits jumped up considerably, but you know why they jumped up considerably? Look at this. Because they got a $483 million tax refund. So their profits went from 1,789 to $2.27 billion. Last year, they actually had a loss of $600 million basically, but they got an $850 million tax credit that put them to a profit of $250. So as long as the IRS keeps giving them $500 million a year, they're an incredible company. So you have to be careful about that. Now, I don't see that in AIS, and I'm not doing a full analysis. Ask me in chat, and I'll be happy to go over it a little bit. But they don't seem unreasonable. So I'll buy that. They seem like they're kind of legitimate as far as their growth goes. They're currently valued at $2 billion. Analysts say they're going to make $4.50 a share. So that's, on all counts, it looks like a very reasonable thing. So I'll be happy to look into it more closely in chat if you'd like. So feel free to re-ask that. Seems like an okay stock. And then you say options reasonable, but not great. So let's take a look as if we're doing it. AEIS. What am I doing? Oh, stupid me. What was there? Probably oil. Ooh, do I still have oil? I do. All right, well, that's it. My premise is done. So I missed the lows, but I'm going to get out of these because I don't need, wait. Position flat. Oh, no, I'm flat. I don't like this view. I got to change this view somehow. 4x2. I'm not flat. I'm very confused. Well, it says I'm flat, so I'm flat. All right, I guess I'm out of my rules. I didn't even realize. Okay. Meanwhile, what's this? This is coffee. Oh, you bastard. Look how far it fell. See, we were way up here, and right into the close, it fell like tremendously. That sucks. Anyway, so that's why earlier I said, let's take half off the table here because it was getting crazy high. And I'm glad I did. So I took some profit, but I still have 4 open and there, so we're okay. It's by the way, the market's just generally too crazy to play the futures, but you can play the NASDAQ if you want to be technical about it. Below 76, you can play it short with tight stops. But there's no particular reason to do that other than you'd expect some sort of rejection off of 7,600. Oh, what were we going to do? We were going to look at AEIS though. See, too many things going on. AEIS, because you said you didn't like the options. Oh, well, they don't have long-term options. That's a problem. So you can only go out till April, which means they're also probably very thinly traded. Spreads aren't that bad though. So if you're playing them at 53 bucks and you sell look, if you like them, you can sell these puts to 45. So your worst thing that happens to you there is you get a net entry of 43 bucks, right? If you sell them for $2 and change. And as far as the long goes, see, now what's reasonable? They're at 53. The 50s are 7 something. That's ridiculous premium. So they're paying 57 something. Here, though, the 45s are not so bad. They're oh, well, figure they're 11 something. So you're paying 56 here. The 40s are, let's say they're 1550. So that's 45.50. See, that's not terrible. But then, see, when, you know, in other words, when these options are ridiculously expensive, then you say, well, maybe I should get something lower. So let's say you took the 40s for 1550 and you sold the 50s for 775. So that half, yeah. So that would be 775. Yeah, it's not exciting. It's no, then it's not, because then that would be 775 on the spread, and you're in the money, but it's not a very exciting play. Then you look at the 45.55 maybe. That would be 11 minus 5 is 6. Okay, there's one. So if you think of getting a value, if you took the 45.55 spread, right, for $6, and you sold the 45 calls for $2, and you get a little bit more on either side, you're going to be in the $10 spread for net 4. That means your break even is $49, which is 10% below where you are now, and you'll make $6, 150%. If they hit 55. So that's the way I would play it, like something gentle like that. And again, I don't have any particular reason to play them, but I don't know what the catalyst will be for them to go up. But it does look like a reasonably priced stock. So if it's something you're interested in, that's how I'd go. Randy says, I'm going back to work. Retirement with kids is great. But that not so much. Yeah, it's me too. For me, it was when they went to high school. I got more into I was doing PhilStockWorld, of course, because that was like a work at home sort of thing. So I got to hang out with my kids all the time. But then when they went to high school, I got really bored, and that's when I started PSW Investments, because I was like, I got to do something else. I can't just sit around here because there's not enough to do with the kids in school. Bill, you seriously need a larger platform because your rant is clear and understandable. Well, thank you, Randy. What about when the right feels pain? What about when the right feel? I want to get into a whole political thing about that. When the garbage cans are empty, nope, also political. AEI is acquired. Oh, thank you. Okay, Eric, that's good color. So they acquired somebody in July 2017, and that's why they jumped up. So apparently it was a good acquisition. They kept things in line. It's a very respectable sort of thing. Unfortunately, though, not, and again, this is why we say, do you follow them? Like, I don't follow them. I don't know why I don't follow somebody, but when I look at them, I'm like, oh, I don't follow them because they don't have interest. Their options aren't that interesting. They're not terrible. It's a nice, solid little company that you can pick up a good deal on. But, as you know, from the way we do options, 150% isn't thrilling for us. It's just nice. But it is between now and April. It's only 210 days. So it actually is quite good. It's as good as any of our plays. If we do 300% in 2 years and you do 150% in 200 days, you're doing better. So it's definitely a good play. So if you don't have any bumps in the road, that is definitely the way I'd go with the 45.55 spread and the short 45 puts. The net would be under $6 and you'll collect 10. No, I'm sorry, the net would be under $4 and you collect 10. That's what makes it nice. There's nothing wrong with that. Portfolios, that's what we were going to do today. We're going to look at the portfolios. So, like I said, the insanity of the long-term portfolio. But let's look at the other ones. We have the Money Talk portfolio. This is the one where we only make trades when I go on the show on Business News Network in Canada. So it's up 77.8%. Last time I was on, we cashed out. Now, cashed out doesn't mean no positions, but we have as much cash as the entire value of the portfolio. We started the portfolio with $50,000 on started $50,000 in last 1 year ago, basically exactly 1 year ago. So we started with $50,000, so now we have $85,000 in cash. So we basically locked up our cash. Now, that doesn't mean we don't have no risk. We have a lot of leverage risk. The net value of these positions is only $3,000. So we're using very little cash, but obviously they can go against us, they can go in our favor. But the ones we're left with are the ones that we thought were very, very much bargains. So we have our hedge SQQQ. We have Alaska Air, but only the puts left. We cashed out the longs. We have Barrick Gold, which I think long term is going to make some money. We have GE, which is still, even today, somebody else downgraded it. So GE again is a really down in the dump stock that I still like. GIS is General Mills, also going nowhere, but we just picked them up. They're new. LB is L Brands, and they've come back a little bit, but nothing too exciting. But of course, we're only looking to get to 35 in 18 months or in 16 months now. So we're only looking to get to 35. They're at 30. It's not terrible. I mean, now it would be terrible if I think our original target was 40. We've been knocking down our target and adjusting the position, but that's what you do. You know, the stock didn't go well at first, but what we ended up doing is now we have a twice as big position at a much lower strike. So hopefully it'll just manage to maintain itself. And last of all that's our LB is our this year's trade of the year. Wheaton Precious Metals, WPM, was our 2017 trade of the year. And that also has been beaten up tremendously. But fortunately, with Wheaton, we took the profits and we flipped ourselves to a fairly bearish position where we are short the January 22 calls, and it's well below that now. In fact, I'm almost ready to take these off the table. In fact, I'm sorry, I would take these off the table, but I'm not on TV. I can't make a move until I get on TV. But these are stupid to leave on at 12 cents. If I clear the slot, you know, and then this spread is obviously high, but the reason we have that high spread, it's not because my target is 30, it's because we took we have like the 15-22 spread. We had 50 of the 15-22s in January of this year. We cashed our 15s when Wheaton was high in the channel. Let me see if I can find one. And I was talking about this, about non-greedy exits. WPM. So when Wheaton was at 22, we cashed it out. We cashed our 15s out. That was our goal. And by the way, that's also, people say, why do you choose certain strikes for your things? One of the reasons I choose a strike also when I'm doing a long spread is that it reminds me what my target was. You know, it's not just about picking a strike, but like, you know, when you're looking at 100 different positions, it's hard to remember exactly what you were thinking on every position. So by choosing spreads at my target prices, that way I know when we're over my target. You know, so I can immediately see, well, we're over my goal. And if you're over your goal, you have to start considering strategies for getting out. We hit 22 a year and a half early, so we cashed out. And not only did we cash out, though, we left the short calls, the short 22s we left on, but because I was worried it might go higher, we hedged with the 22. This is on 7/19, so you can see exactly where we did it. So on 7/19, right about here, we cashed in our 15 longs and took whatever off the table, at least $7 off the table. We left the short 22s because I thought that it had gone too high. And then, but just in case it hadn't gone too high, you know, having taken 50 times 7 off the table, which is like some huge amount of money, $35,000 or something. Having taken that off the table, we left the short calls, and we're hoping that they would lose value. Now, and it turns out they lost all their value over this time already. But to hedge that, we took the 22.50-30 call spread. Why? Because God forbid it went back up. Then we're cushioned to $30 on the new spread. So we took off $35,000 right off the table on the $15 calls. We left these to dry up to die, and then we spent $6,000 on this spread to cover us just in case the stock went up. So we ended up taking $29,000 off the table. But now it turns out that whole $29,000 is going to be profit. So and not only that though, but whatever value is left in this position also. So we did fantastically on this position. And that's why it was our trade of the year. So hopefully LB will end up the same way. Hopefully LB will take off at some point. We'll go higher than we think it even deserves. We'll cash out the 2750 calls and we'll leave the short 35s and we'll take a cover position in longer positions. That's how you play the game. You know, you don't stand there with your positions and leave them all. You have to look at every position every month and say to yourself, is this really worth this? What do I think is going to happen next? And it's okay, no matter how much you love a stock, it's okay to say, you know what, I think it's probably going to go down for me. I think this is too much money. You know, I love Apple, but when you get to $1 trillion+, I have to say, you know what? What are they going to do to justify another $100 billion? Every 10% on Apple now is $100 billion. And so you have to say to yourself, in a rational market, this isn't even a rational market, you have to say to yourself, well, okay, so for them to make another $100 billion in market cap, they have to make at least $5 billion in earnings. And you look at you look at what they're offering, you look at how they're running the company now, you look at the profits now, you say, is it realistic to think that what they're doing, what they're promising to do now, the new line of iPhones, the new line of iPads and all that, are they going to get another $5 billion out of that? Are they going to increase their profits by 10% more? And if they're not, then the stock begins to get away from itself. Now, Apple's not really at that point yet. I'm not shorting Apple, but I'm saying you start getting to the point where you have to start considering, like, maybe it's too much. And this is a very dangerous spot where it is right now, because over $1 trillion, like 1.1 trillion now, every time they go up 10%, they have to somehow justify $110 billion in additional earnings. And you got to be critical about your own stocks like that. Now we took Apple out of this portfolio, in fact, in the money talk. So we took it out in July because I was just like, I'm sorry, I can't risk it. Not in a portfolio I'm not allowed to touch, because God forbid the whole NASDAQ went down and took Apple with it, it would have wiped out half our gains. So that's the money talk portfolio. We got the butterfly portfolio, and that's up 35%. It's all it should be up. The butterfly portfolio, because we're always betting against ourselves. All these positions are kind of self-hedging where they bet against themselves. So you shouldn't be, if you're making too much money, there's something you're doing it wrong. But it should make a nice steady amount. It did make 5% since last month. So that's all you're going to get out of this thing. It almost physically can't be, or mathematically can't be, a 60% gainer. It also, in theory, shouldn't be a loser at all. And that's the magic of this portfolio. It pretty much always is in the 20 to 40% range every year. It's very hard not to make 20. It's very, very hard to make more than 40. That's the way these trades work. They're very conservative. We have tons of cash. 87,000 is cash. And at the moment, we're still bullish. We're still bullish on Apple. We haven't sold short calls on Apple recently. Disney, we're bullish because wait. No, Disney, we have a half sale of the September 110 calls. Mondelez, we have I'm sorry. We sold some puts and calls, but very small, because we have 20 longs. We have the 40-47 spread. We only sold 5 puts and calls. So we weren't sure what was going to happen. We don't want to go too overboard on that one. And OIH, we sold the October 25 puts and calls against this long position. So, and notice though that we don't have enough like cover. So we are generally bullish on OIH because we have 15 long calls, 30 short calls. We're selling the front month puts and only 5 front month calls, which is the amount that we have uncovered. We could sell 10, but we don't think OIH is going down. We think it is going up. So why would we sell more calls? OIH. That's the ETF for oil services. So we're looking for OIH to get back up here. Then we'll sell some more calls. But down here, we don't want to sell too many calls. But that's what we do. Every month, we look at every position and decide what we're going to do next. What's it going to do for the next period of time before we look at the portfolio again? Options opportunity, also in the 30s, I think. 41. So ridiculous. I think it went up $1,100 today. Since this morning, I said, "Oh my God, 40%." Now it's at 41. And we have some. I mean, that's despite some disasters. We have Helios and Matheson. We lost more. We lost more than this, I think, but we lost 4,000 at least on Helios and Matheson. We've got obviously the hedges are losing money. This hedge lost 7,600. This hedge lost 3,000. We've got ABX, Barrett Gold, huge loser. So if it wasn't for the losers, we'd look like the LTP. That's a fact. If it wasn't for those losing positions, this thing would be doing the same as the LTP. The LTP, and don't forget, several of the losers are hedges. The LTP has hedges in another portfolio. What we don't do in this portfolio that we do in the long-term portfolio, first of all, we have a lot more money and more flexibility in the long-term portfolio. But what we don't do in this portfolio is it's only a $100,000 portfolio when we started. What we don't do in this portfolio is hedge the hedges. And that's a real advantage we have when you have the large amount of money that you can allocate to the long-term and short-term portfolio, which is $500,000 in the long-term to start, $100,000 in the short-term to start. Then, because you have $100,000 in your hedging portfolio, in the short-term portfolio, you can then hedge the hedges. And that's where the huge advantage is, because we're not losing money on the hedges. In this portfolio, we are flat out losing money on the hedges. When you lose money on the hedges, you lost the money on the hedges. There's no other thing that we're doing. We don't take quick short-term trades in this portfolio to offset the losses like we do in the short-term portfolio. So the long-term portfolio, short-term portfolio strategy is for very active investors. Not for just, not for people who are just trying to run a once in a while portfolio. Northern Dynasty, another disaster. I mean, look at these freaking stocks. They're terrible. Now, we have Northern Dynasty in the LTP too, but in the grand scheme of things, it washes out. And here it's like a big gaping hole, $11,000. Anyway, so what positions do we have? We have, I don't want to get over everyone, but we have coffee not doing well, but I like it. Oh, we just took this one. That's why I like it. Frontier making a comeback, still negative, but coming back. I like them. And they pay a nice. Oh no, they don't pay a dividend. Sorry, they used to pay a nice dividend. Oh, here's that Alaska Airlines position. I don't remember what we did. Did we cash it out? Whatever. It turned around so nicely. In the long-term portfolio, we cashed it out, but here we still have it, or whatever it is here. Best Buy is making a bit of a comeback. BHC used to be VRX, and they're a fantastic winner for us. Citibank, we're certainly not worried about going forward. They're probably going to make a ton of money. CDE is another miner. We like them. CHK is natural gas. We like them. FNSR is fiber optics. We like them. GE, of course, same thing as the dog. GNC turned around a bit, but still not back to where we want them to be. They pulled back a lot. They were over $4. They can pull back a bunch. HBI is Haynes brand. We like them. If they're alternate to LB, we like them. We have LB too. HRB is H&R Block. During tax season, they tend to take off. So have to wait for tax season again. Northern Dynasty, we said. Annaly is a real estate trust, and we like them long term, and they pay a nice dividend. OIH, we said, which is good. SunPower just took off again, so they're doing nicely, coming back. That's still great as a new trade. Walgreens Boots Alliance, another powerhouse that's doing well. And Wheaton Precious Metals, as you know, we love, so that's another one that can still be done as a new trade. So, the thing is, we sold all the ones that did good, and now we're left with all the ones that haven't done good. So a lot of these trades are fairly negative looking, but we took all the profits off the table, or a lot of the profits off the table, and now we're left with ones we're still working on, but they've got a lot of potential. And in a runaway bull market like this, it's surprising. If the market keeps going up, these things are going to take off. If the market doesn't go off, we have a lot of hedges, and we're pretty well hedged. So although we'll have to adjust those hedges again if the market keeps flying like this, but we can do that because we made like $7,000 last month. So we can take $3,000 and put it into making the hedges a little bit better. That's the way it works. You just have to keep a balance as much as you can in your portfolios. Garrett says, today Disney is above the 110 call strike expiring tomorrow. What do you have to roll today? In what portfolio? In the long term, in the butterfly? I know I'm sure we said what to do. Where is it? No, it wouldn't be Thursday. It would have been yesterday, right? I believe we went over the butterfly portfolio yesterday. B-U-T-T-E-R, butterfly, Disney. See? Okay. The October 110th only paid $2. That's not enough to pay there. So I guess, okay, wait, what is it? Looks like we nailed it with the short September 110s. There's money we collect against blah, blah, blah. Okay, so at the moment, I don't know where Disney is at the moment. I know, something good happened on ESPN, right? It went up. I remember hearing that today. Something nice about ESPN subscriber numbers. So they went up to 111.68. So basically, if you still have it open, because we talked about getting rid of it yesterday, but if you still have it open, you pay the caller back. The short caller is a 110 caller, so you owe them $1.68 instead of 47 cents yesterday, right? Because that's what you do. You pay them whatever it is over 110. That's the end of that caller. Then what did I say we're going to do? We're going to sell 5 115 calls for $245 and 5 105 puts for $440, and then we're collecting another $2,450. That's it. See, and when you get into the last week, you should really, you got to put stops on these things also. It's very important. If you're ahead, don't blow it. Although I think what happened today might have been sudden. I think they gapped up. I generally think about positions like this as if I have apartments, and each one of these positions is an apartment. So I have a position in the apartment that allows me to then rent it out. So I rent it out, and there are seasons. And sometimes you have a good season rental, and you rent it out for a lot. Sometimes you have a bad season rental, you don't. Sometimes something breaks, and you have to fix it. So when a position goes against me, it's broken. This position didn't go against us though, because we collected 420, and we're paying back 165. So we have a profit of whatever the hell it is, 260. So in this case, we thought we were hoping to get 420, but we got 260 instead. But that's fine. It's plenty of money. You're not always going to win, but that's okay. We have a lot of positions. Some are going to win, some are going to lose, but on the whole, it just keeps dropping money in your portfolio. I mean, 260 times 7 is $1,600. That right there is 1.5% for the month. We're only trying to make 1.5% for the month. That's just one position. What's going on here? Huh. Okay, sorry, seem to be getting some calls. Just one moment so I can see if this is important, because it rang a bunch of times. Nope, not that urgent. Okay, sorry. I love that my new computer has a wireless charging thing. All I do is put my phone on it and it charges the phone. It's excellent. So it's got a little base, and all I do is put the phone on the base and it starts charging. Excellent. Anyhow, so where was I? I was pontificating about something. Butterfly. Oh yeah, it's just a business, and again, it goes back to that casino model we talked about. They're just casino games. You keep inviting people to play, and most of the people who play are going to lose. It's statistics. Some of the people who play are going to win. That is also statistics. But in the grand scheme of things, it doesn't matter because the odds are tremendously, as a seller of premium, the odds are tremendously in your favor, and you are usually going to win. And as long as you keep playing the game and you keep selling premium and you invite more and more players into your casino, you will make more and more money. And that is that's exactly what the long-term portfolio does. Oh, I'm sorry, what the butterfly portfolio does. It's all about playing that casino game over and over and over again. We sell puts, we sell calls. We say, who wants to buy a put this week? Who wants to buy a call this week? And let them pay the premiums, because we know what the gamblers don't understand, is that we know that no matter what they do, no matter how lucky they get, the premium we sell is going to expire worthless. For a fact, every time premium expires worthless. The position doesn't expire worthless, but the premium they paid to own the position always expires worthless. And that is a tremendous advantage you have when you're playing this game. You know, can you get burned on a huge move? Yeah, you can. That's why we have those longs for the insurance. Our long positions, the gist of it is we try to pick value positions that we think are going to go up, but won't go up that much. We're going to go up and stay in a channel, so we can take a long-term position. The long-term position becomes our hedge for selling the short-term positions. So in other words, we try to, I don't want a position where I'm worried about it going up or down. I don't want to like do that pot stock till rate. I don't want to do it in that because it goes up and down $50 a day. You want to shoot yourself if you sell calls and puts on that one. But for a regular stock that doesn't have a lot of variance like Disney, so it's going to go up and down $2 during a period usually. I'm selling $5 worth of premium, therefore I'm going to make $3. I'm fine with that. Most of the time, I'm going to make $3. And if my long position only costs me $4 and I make $3 on 4 different quarters, that's $12. Then my net is going to be $8 or $9 back. That's the way to play it. I don't care when I win or lose. I don't care if it goes up or down. I only care that I sell my premium that's going to vastly outweigh what I put into the position. And so it has to be extremely unlucky not to win. That's what it's all about. This is not gambling. This is investing. This is not trading. This is investing. The stock I'm buying is like an apartment. It's as if it's not so much that you own the apartment, so I'm renting because I'm using options to buy my position, but I'm renting a long-term position. So, let's say I rent a shore house, right? And, a beach house. And let's say a beach house, you know how they rent really expensive in the summer and really cheap in the winter, right? So let's say the landlord's, he wants to lock in a year. So I say, okay, tell you what, I'll give you $4,000 a month for the year. I'll give you $48,000 for the year. But I know that in the summer I can get, I can get $10,000 a month in the summer. So in June, July, August, and September, in 4 months, I get $40,000 and I rent it out. So I'm subletting it, whatever. Now, all I have to do the rest of the year, since I paid 48 and I get 40 for the summer, and that's almost a guarantee, like it's always going to fill up in the summer at high prices. So now I say, okay, all I have to do in the next 8 months is make more than $1,000 a month and I'm have a profit. But the thing is, before I do that, I have to think about it. So I want to know, am I sure that I can get renters in June, July, August, September? And I can tell you if it's like Fire Island or the Hamptons, which is a place on the Jersey Shore, I know for a fact that place is going to get rented. It would have to be the worst possible house not to rent it out. unless there could be a hurricane, something bad could happen. But year after year after year, I've rented a house since I was in college. Me and my friends used to rent houses on Fire Island. They never don't rent, never seen it happen. So they're going to be full from June, because that's when people start renting. They start in June, and they'll pay 4 months. The people fork over the money for it, and they'll pay 4 months for the thing. That's almost a guarantee. So that you got in the bag. The landlord, though, he looks at it differently. Like a landlord might say, because any individual landlord is going to say, oh, you know what? Last summer I only rented 3 out of 4 months. He could have had bad luck or whatever. So he's willing to talk to you about giving you, if you guarantee him the whole year, then he doesn't have to worry about getting someone in the winter, so on and so forth. You're willing to put in the legwork. Now, you have to have a realistic expectation, though. Are you going to be able to put someone there in the winter? Now, in Fire Island, it's really hard to put someone there in the winter because you have to make a real big effort to get there. It's like you have to take a ferry from New York to get to Fire Island. You can't just, you can't just drive over there if you feel like it. Plus, it's freaking cold, and there's absolutely nothing to do on Fire Island in the winter. Very hard to rent a house. But on the Jersey Shore, on the other hand, it's perfectly nice in the wintertime. There's still plenty of bars and clubs and places to go. It's still fun. So people go in the wintertime, and people rent houses. And people, in fact, a lot of people come there in the off season because they can get a nice place on the water for $1,000 a month. Like, 3-bedroom on the water for $1,000 a month, because the landlords there are just happy to get anything. So you have to look at your available rentals and say, am I being realistic in this position? Am I expecting to collect enough money to cover my long-term costs? Now, the nice thing about the options trades is that we're not buying the stock, because instead we're taking a spread that mimics buying the stock. And what it doesn't do, though, is it doesn't cover us if the thing goes up to infinity, like Tilray. If it goes from 50 to 300, you're screwed because you don't have the coverage. But if we take a stock like Disney, and we buy the 100-120 bull call spread as a backstop, well, what do we actually have? Let me tell you. I don't think we have it that wide. Oh, we lost the butterfly. So in Disney, we have the 9250-110 spread. So we're covered by our longs. We paid $9 for a 1750 spread. So we have $8 worth of upside protection against any calls we sell. We don't have infinity. If it goes to 120, we're in trouble. But but anything around 110, 115 is fine for us, because we make more money than that on our longs. That's the point of the position. And we sold some puts also up there, so that's, for whatever reason, they're not connected. But we sold some puts up there. So we actually paid less than 9. We paid more like 6 for our longs. So that upside becomes our cushion against the short calls that we sell. But instead of paying, now let's do the math, because instead of paying, we didn't pay $100 for the long position. We only paid net $9. And I'm sorry, 9 minus, well, it's a half sale. It's not even a half sale. It's a third sale. So 9 minus 2, we paid $7 net for the longs. So it's 1/3. So we collected $2 per long there. These are 9, so that makes 7. So we paid $7 for the long position. We have $7 of upside protection. We're selling. Now it's a half sale, so we're selling $2 from 7/20 until September, so August, September. So for 2 months, we're selling $2 against our 9. We're collecting 20% back, more than 20% back, against our outlay in 2 months. How many times do we get to sell that? Well, if we have 16 months left to go, we're going to get 8 sales like that. 8 times 2 is 16. So that means that we're looking at a situation in which we're taking the long position for $7, or $9, or whatever I said, $7. We're taking a long position for $7, and we're going to collect $16 worth of rents. That means we have a hell of an upside potential, right? We have an upside potential of 140%. So why doesn't the butterfly portfolio make 140%? Why? Because sometimes we don't win. Sometimes we win, sometimes we don't win, but generally we're going to win, and we're going to win more than about half the time. And as long as we win a little bit better than half the time, that's our profit, and that's exactly where this money comes from. But it's just math and statistics. And that's why it's very hard to lose much money in the butterfly portfolio. It's also very hard to win much more than 40%. Statistics cut both ways. It's not that likely that you're always going to be at the money. It's not that likely you're always going to finish exactly where you predicted. But you make your adjustments each month. You roll things sometimes. Sometimes you cash them in. Sometimes you'll take a chance that you think something's too low or something's too high. But generally, we keep selling premium and we keep collecting the premium, and we know every month that premium at least we're going to get. That's our benefit. Then it's a matter of whether the position is up or down or right or wrong. But since we guarantee that premium, it gives us such a tremendous edge against everybody else, we're going to make money. And to some extent, this is the most obvious use of what we do, the Be the House strategy. But to some extent, that's what we do in all of our portfolios. Every portfolio is geared that way. We take a leveraged long position and we sell front month premium against it. Most of the time, most of our positions, that's what we're doing in one form or another. And that's what the whole concept of being the house is all about. All right, butterfly, we did all these, right? You do the short term? No, I don't think so. Well, the short term is all about the hedges. So at the moment, of course, our hedges are being killed. DXD is down. Well, it's not down that much. DXD is down, but what? The bottom line is we have the 28 calls, and DXD is now down to 28. With SQQ, we have the $10 calls are down to 11, and with TZA, we have the $7 calls are down to 8. It's almost time for us to make another adjustment. So we have to think about what we want to do. Now, one thing we want to do here, look at SQQ. The January 25 calls are down to 20 cents. There's not really any point to keeping those open. They're only going to make 5 cents a month for the next 4 months. That's not worth it. So we're probably going to reposition these at this point. We can still salvage most of the money we put into the calls. And that's interesting that these calls are keeping their value because people are putting a lot of money into hedges. We're not the only ones. But we can still salvage this money from these calls and roll to a longer month. And all that's doing is buying more insurance. We're extending the time frame of our insurance. And then we'll sell something else to cover, which will be more than 20 cents. So we'll actually have a cheap roll to a longer position. We get more insurance without spending more money. And that's the game that we play there. And that's what we're always looking to do in the short-term portfolio. We're trying to minimize the cost of our insurance. We want to make sure that if the market drops 10% tomorrow morning, that's what I'm always looking at. If I wake up tomorrow and the market is limit down 10%, because something blew up or whatever the hell happened, I want to know that I'm at least 50% covered. And so hopefully more. So I say to myself, well, how much is the long-term portfolio going to lose if the market drops 10%? Well, it's leveraged, so it's hard to say, but I could look back at where we were when the market was 10% lower, and I'll say we're going to lose about $200,000 a month from July. So we'll be back to where we were in July if the market drops 10% overnight. So that means we're going to be down $200,000. So I want to make sure I'm going to make at least $100,000 back in the long-term portfolio. I'm sorry, in the short-term portfolio to mitigate the damage. It's not about completely erasing the damage, because if you try to completely erase the damage, you're going to end up overhedged and you won't make money in either direction. You have to pick a direction and say, okay, I'm generally bullish. I think that we're going to do this, but if I'm wrong, I want to mitigate the damage. And as a rule of thumb, what I do is I take, now we're not going to do it now because the profits are too ridiculous, but generally I'll take 1/3 of the profits of the long-term portfolio and put it into the short-term hedges to lock in the gains. But the long-term portfolio made so much money now that we don't need to take 1/3 of the profits. That'd be like $70,000. We're going to take maybe $20,000, $30,000 and buy more hedges, or improve the hedges that we have. Although these are pretty strong hedges now, it just is crazy how much we made. So much money that we need more hedges to cover all the additional money we made. It's nuts. This is a crazy market. Then, looking at the long-term portfolio, there's several ways we make money here. Oh, look, another 1%. Yay! Yeah, every hour 1%. That's fantastic. It's so normal. Don't worry about it. Don't. Yeah, we make 1% an hour. You know, that's how the stock market works. Oh my God, this is so insane. One way we love selling premium is instead of buying a position right off the bat, we sell a put. So when a stock goes low, rather than jump into a position long, we sell a put. Because the nice thing about selling a put, like here's who's still at the money? KHC. Okay. So KHC took a dip, and let's see where they're at now. So they're $70 billion. Okay, I like them the same way I like General Foods. So they took a dip. Their PE is 6. It's just stupidly low. So when did we do this one? We did it a while ago. So back in March when they first did that. Where's my picture now? So back in March when they first started falling, I said, you know, 60 seems low enough to me. I think that's about the right price. So based on that, I said, since we had this nice dip, and I said that's just below where I said I would buy the whole company for $58 billion. If I had $58 billion, I'd be very happy to buy this company and just go on vacation. So you know, and it sounds like $70 billion. So, but I don't have to pay that much money because I can still give myself a discount. And the discount we gave ourselves was I sold the 5750 puts for $550. So that drops our net to $52. So this was what, March 22nd. So on March 22nd, we were down here roughly at 60. And I said, well, you know what? I'll sell the 5750 puts because I think that's as low as it's going to go for $5. So my net is $52, which is way down here. And I said, that is such a ridiculously low price, which would be about $63 billion for the company. That's such a ridiculously, and the PE would be 10 at that point. So it's such a low price, I would be happy to buy it for that much. So the PE wouldn't be 10, the PE would be like below 6, like 5 something. It's freaking Kraft Heinz. It's ketchup. Okay, do you not buy ketchup because of the price? Do you not buy mayonnaise because of the price? Do you go to the store and say, no, I'm not going to get ketchup. It's not a thing anymore. If you ever go to a restaurant and not see ketchup on the table, and the people and the restaurant goers go easy on the ketchup because it's expensive. Do people take less ketchup packets at Burger King because they think ketchup might be too expensive? No, it's economically inflexible. You consume it the way you consume ketchup the way cars consume gas. You're always going to use it. It doesn't matter. It doesn't matter what the economy is like. You are going to use ketchup. And they're not all ketchup, but you get the idea. It's silly to imagine that this company is going to go bankrupt or anything like that. It's a freaking staple item. They go in and out of favor, but as far as the bottom, it's really easy to call a bottom on things like this. So we sell a put. Now, I did not find myself motivated to believe they would turn around anytime soon. So we never added a spread. But usually when something stabilizes for a while, we'll tend to add a bull call spread. And on this pullback, if it holds up, I would like to add a bull call spread to that position. But to start with, very simply, I say, you know what? I'll buy 1,000 shares of this stock if it goes down to $52. You know, we would get it below 57.50, we get a sign, but our net is 52. So I'm saying I'm willing to buy 1,000 shares at net 52, and I'm going to get paid $5,500 to make that promise. And if it turns out they're above 57.50, they expire worthless, and I keep the money. And that's how we initiate. Many of our positions are initiated that way. And basically what I like to do is every month I try to find something in the range of $5,000, $4,000 to $5,000. Every single month I try to sell at least one put. So on a rotating basis, we have 24 puts in a 2-year cycle that are each month are getting close to the expiration. So if there's 24 puts, and they're $5,000 each, that means we have $100,000 basically worth of short puts, and they're expiring every 20 months. So that means every month 5% of them expire, which means we're making $5,000 a month just on the premium erosion of the puts. Now, some of those puts will go against us, some won't. In this particular case, looking at 21 puts, 2 are going against us. 1 is barely against us, and 1 is actually bad. Whirlpool. I'm not worried about owning 500 shares of Whirlpool. And we sold the 130 puts for $11, so our net is $128.80. No, I'm sorry, $118.80, and we're $122.95, so it's not even below our net. So it could say minus $41.50, but frankly, if it finishes here, we still have a profit. And Whirlpool's not. Now, it's a tariff issue with Whirlpool. That's why people are bailing on Whirlpool. It's a fantastic thing to pick up, but that's another one I'm interested in adding to at this point. So you know, the funny thing is when I see these puts go red, I'm looking to add to it. I'm saying, oh, good, they got cheaper. I like the stock when it was not red. When we took the position, I like it even more when it gets cheaper. So Whirlpool, because of the tariffs, is way down here. This is a fantastic stock to pick them up at. So we're probably going to add to the Whirlpool position too. And that's what we do. We turn puts into winning positions. Now, if we don't do that, they end up expiring worthless. If they don't go down, if they don't go down, we make money. And it adds up. You got, I don't want to do, well, let's do it quickly. It's like 3, 12, 15, 18, 22, 30, 32, 38, 44, 49, 55, 60, let's say, 66, 73, 83, 93, 95, and 100. So there you go. It's exactly what I said. So it's $100,000 in 21 puts. It's doing exactly what I said we do, right? So we have 20 positions. They're $5,000 each on the average, and we have $100,000 of short puts, which are pretty much all premium. We almost always sell puts that are out of the money. And they erode over time. Now, most of these are Januaries. You know, they're this January, next January. So some are going to come off the table this January. This one happens to be September on Canadian Bank, and they're going to expire worthless. It's over our strike price. So we're going to just collect $2,250 and get paid for not buying the stock. It's right at the target we had. That's fine. We'll probably sell it again because I still like them. I'll still buy them if they get cheaper. But you know what? I'm happy to collect $2,250 for not buying them. So that's step one. And that's enough. Keep in mind, it's a $500,000 portfolio, and just doing this, just promising to buy things when they get cheap, we're making 10% a year on our money. Then we've got our dividend stocks. Now, some of the dividend stocks are down here, like Armor came. If we didn't do it evenly, the thing puts it in down with the uneven position. So Armor, we didn't sell. We don't have the call, so it counts as an uneven position. These are just all stocks we're in it for the dividends. We don't really care if the position makes money. We're in it to collect dividends on these stocks. Then down here, we've got spreads, and here's where, like I said, we're very much like the butterfly portfolio with these. We're generally looking to have a position, sell some calls against it. So like here's Apple, and we sold 5 190 calls. Now these 190 calls burned us for quite a lot of money. So what are we going to do with them? We're going to roll them along to a higher strike in a longer month, and hopefully they'll catch up eventually. If not, then we'll have to adjust the position. But on the whole, we're not getting killed by it. 58 minus 46 is, well, 46 plus 12 is 58, so it's 0. So these guys cancel out, and the profit would be $4,000. So not exciting so far, but we have all the way until 2020 to roll this position. And frankly, probably we can, I don't want to jump it, but let's see, this is $43,000, and it's a $30 spread. So it's a $60,000 spread. It's $43,000 in the money. So we may want to consider getting a whole new position at this point. I'll have to see. We'll do that review tomorrow for the long-term portfolio. We have Barrick Gold, we have ALB, we have Alaskan Air again, Amgen, Armors, a REIT, which I like. Not Best Buy, Bed Bath and Beyond. I like them. BHC is back to that's the old VRX. Coffee, Citibank. So a huge. Notice it's a huge variety of things like banking, fiber, industrial, cereal, underwear, tax returns, computers, movies, underwear again. Maybe a lot of underwear. Actually, the boys' underwear and girls' underwear, so I consider this diversified. Smoking, cigarettes, mining. I'm sorry, steel. Back to another REIT, a bank. I have not yet in a bunch of and I was reading 1/3 of the portfolio off to you. I haven't other than underwear being men's and women's. I haven't even said the same industry twice. So what do we do? What did we do over the last year? This has been 1 year. We've only been doing this for 1 year. In 1 year, we put together an extremely diversified portfolio where we don't have a lot of risk in any single sector, and where the positions are proxies for owning the stock, where we sell the puts. Almost all of them have a short put, because to me, the short put is the greatest instrument in the planet. It starts off with a short put. How much money am I willing to pay for NYCB? Well, I sold the 13 put for $1.50. That's a net $11.50. So I'm willing to own NYCB for $11.50. It is $11.50. It's below $11.50. And I bought the 11-12 calls. So we think they're going to get back to 12 by 2020. We'll see what happens. The short calls in January, I get to sell more short calls now if I want to recover. But at the moment, I probably wouldn't recover. Here's shoes. Okay, here's telecommunications. Here's coffee. Here's shoes. Here's solar. Here's again telecommunications. Diverse, and we sell puts. We sold Starbucks $50 puts for $5, so our net is 45. We're well over that. We sold Skechers $30 puts for $5, so that's net 25. We're in that range, but still, that's what we're comfortable owning them at. That's all we do is we offer to buy a position cheaply. If we feel strongly that it's going up, we'll take a bull call spread. And once we have a bull call spread established, we try. It's like our apartment. Once we have the bull call spread, it's like owning the apartment long term. And I say, well, it's a shame to leave this thing empty, so we rent it out. And we collect money by renting it out. And the money we sell when we rent it out is all premium. And we're well covered with our bull call spreads, and we keep selling the premium. And that is our strategy. That's what we do, and that's how we make 80% in a year. And 80% is not normal, but that's how we make 40% most years. 20 to 40% using strategies like this, you should be able to make very, very consistently. And I've got these portfolios doing it. We have a hedge fund doing it. That's, hedge fund with millions of dollars in it, doing that also. It's not limited, it's not difficult, it's just a matter of buying the positions and doing it. The hedge fund also is coming up on its 1-year anniversary. And we've been so super cautious in the hedge fund because, look, establishing a new hedge fund, rule number 1 is don't lose money. Because if you lose money in your first year, you don't have a hedge fund anymore. Everyone pulls their money out and you're dead. And your track record is obviously terrible and you're done. So rule number 1, first year, don't lose money. We have been 90% in cash all year long. We still made over 20%. That's with 90% of the money sitting in cash. We could have made 200% if we fully invested and went for it, doing the same positions. But we're 90% in cash. I'm sorry that people have money in the hedge fund, but that's not how you do it. Okay, once we're ahead, we start taking on a little bit more risk. So over 1 year, 2 years, we don't make a tremendous amount of money, but the 3rd year, the 4th year, as it starts growing and we're willing to take more risk and put more money to work, we can make 40%, 60%. In the first year, though, we just want to make sure we make some money and have some breathing room to take bigger risks next year. And that's all we're doing on these portfolios also. Like I said, the long-term portfolio is a bit distorted because it's all bullish. And the short-term portfolio, I mean, look, frankly, we traded it very well. Very, very well. We traded the short-term portfolio. So because we traded the short-term portfolio very well, instead of losing money, it made money. And that exaggerates the long-term portfolio's returns. But in the hedge fund, we didn't exaggerate anything. We have self-hedging, kind of like the options opportunity portfolio, and their performance is pretty similar. And we lose money on the hedges, we make money on the positions. That's fine. But as these positions mature, we roll them and we make more money, and then we add another layer of position. So if we made 20% this year, next year the same positions will make another 20%, but we're going to add another bunch of positions that'll make 20%. So the year after we make 40%. Then when those positions are mature, they're going to make another 40% next year. And if we add another layer of positions, they'll make 60%. And it doesn't take long before you have fantastic returns all the time. And the positions that you have becomes, if the market continues to go up, of course, if the market continues to go up, or even if it's flat, you're so deep in the money that it's like you paid zero for your apartments and you're renting them out. And you don't have to take a chance of getting burned because you can sell 1/3 of the rent. You can only sell 5 out of 15 positions you have long. And there's very, very little risk that you can get hurt by that, but you're still going to make a ton of money. If I have 3 times more positions than I started with, so if I make 20% on 10 positions, and next year I make 40% on 20 positions, and the next year I make 60% on 30 positions, once those 30 positions make their money, now I made 60% in the 3rd year on the total portfolio. It's almost like everything's for free. So now I have 30 positions that if I just rent out 1/3 of them, I'm still going to make 20%. So I can even cut back and get more conservative and make 20%. So if you luck out and the economy doesn't tank on you before you get a chance to lay out a base, it's fantastic positioning. And it's not a hard discipline to learn. And honestly, I still see people like trading crazy stuff up and down and chasing momentum stocks. None of these are momentum stocks. I don't invest in them. Because by definition, they're not investments. They're gambles. And this is not about gambling. This is about just following a strict mathematical formula, taking value stocks that are unlikely, not that they don't. Some of these stocks really kill us. ABX really killed us. LB was really killing us. Some stocks go down, but they don't all go down because look how diverse they are. Look how and they're all values. However, it's very hard to argue on most of these stocks that they're not good values. They're not nice blue chip stocks that you want to own long term. So even if they kill you in the short run, they're not going to kill you in the long run, and they'll come back. And the best thing is the ones that go down the most, the ones that come back the most of the time. And that gives you a better kick down the road. So, it's not sexy and it's not exciting, but it makes money. And honestly, when you look at that long term and you're looking down the road to retiring, you need to have the money and you need to be sure about what you can do with your life. You want to be set this way, not dependent on your day-to-day gambling, being lucky. It's about building a base that's going to make you money come hell or high water, and it's always going to be returning cash for you. That's what you got to focus on for the long haul. All right, so we're going to wrap it up unless there's any more questions, because I'm very getting hoarse. And I don't see any more questions, so I hope people are actually still on this webinar. But I'll assume they are, and I'll say goodbye. And we'll do it again next week, all right? So take care, everybody. Thanks.
Bye, Phil.
Bye. All right, wait.